Okay, well, welcome Towson University friends, alumni, faculty, and staff. I'm Jenna Mills, the Director of the Alumni Engagement Programs and a proud 2009 and 2016 graduate of Towson University. Thank you for joining us today for our first webinar in 2021. Happy New Year. The webinar is called Tips for Filing Your Tax Returns. Joining me today from the TU Alumni Relations team is Steve Rosenfeld, who is the Director of Alumni Communication and Recognition. Today, we have alumni from the years 1969, the whole way up to 2020, and all the decades in between, joining us from over 10 different states, including California, Delaware, Florida, Maryland, Georgia, Virginia, North Carolina, New York, and Pennsylvania. Before I introduce today's guests, I just want to share a few housekeeping notes. If you've been with us before, you're pretty familiar with them. This session will be recorded. You should be seeing that on your screen, and it will be shared with all the event registrants when it's finalized. Please be patient with us. That does take a few weeks, but I will email you when the presentation is posted on our YouTube channel. Attendees will remain muted throughout the discussion, but if you have any questions, we'd love to hear from you. Please use the chat function in your window and direct your question to all panelists. I'd like to thank those of you who completed our survey for today's webinar. I sent it out a few weeks ago, so if you registered in the last week, you probably didn't receive it, but your answers helped us to shape the direction of the event today. Unfortunately, we might not hit all of the topics, but be sure to ask your questions at the end of the presentation if there's something we missed. I'd now like to introduce Jeff Lawson. Jeff is a 1998 graduate of Towson University and a shareholder with Stoy Malone, located in Towson, Maryland. He holds an MS in taxation from the University of Baltimore, and his primary areas of concentration are pass-through entity taxation, state and local taxation, and individual income taxation. Jeff, I can't thank you enough for being here with us today. This conversation is, of course, very timely. I know we're coming up on the deadline for employers to send out W-2s, so I can't wait to learn more about what you have to share with us today.
Thank you, Jenna. I'm happy to be here on this, what was going to be a snowy day, but more of a kind of rainy, drizzly day. As Jenna pointed out, we have a wide range of ages and graduation dates here. So we have people who have been filing tax returns for probably over 50 years, and other people on this call who may be preparing their tax return for the very first time. And based on, and again, I really appreciate the survey and the input from all of you, so we can gear this appropriately. I'm going to start off with more of a broad overview of how the mechanics of your tax return and how that works. So it might be a little beneath some of you who have been doing this for years, but there might be some things that will that you never knew or didn't really realize. And we'll be pointing out one of the big things was people wanting to know changes for 2020. I won't specifically call those out. Oh, I got a note that I can't hear me. Are other people having trouble hearing me?
Hi, Jeff. I can hear you. Is anybody else experiencing issues with sound? Please make a mention in the chat box. I know Pat seems to be having some issues. Okay. So Pat, you might want to just double check your mute on your computer, and then I'm privately chatting you, so maybe you could just respond to there. Maybe you're using a headset and we can try to troubleshoot. But Jeff, it does seem as though the sound is working. I'm also getting comments that maybe Verizon's having issues.
Got it.
Pat, I'll try to work with you on the back end. Thanks, Jeff.
Yep. And I know too, if you're in a Citrix environment, I know that you sometimes have to access things like this outside of that environment because the computer you're on isn't your computer, so the sound is that. So maybe if someone's having issues, we can do that. Look at that. So yeah, we'll kind of cover the basics. Any 2020 items, rather than just have a specific section of 2020 updates, I'll be just working in changes for 2020 as I get to them in the context of what I might already be talking about. Also, obviously, I'm here for you, so feel free to put in the questions. We might save them till the end, but if they're on point with whatever topic I'm discussing at that point, then um, we'll address them at that point. And obviously, any that don't get answered during the session, I can follow up offline and can reach out to you. There's a lot to cover. Hopefully, we can get through it all. Um, Unfortunately, obviously, it's going to be a big 10,000-foot view. I could probably talk for 8 hours on any of this. So to talk about all of it in 1 hour will kind of go quick, and a lot of summaries. And even for the 2020 tax updates, I kind of pulled out what I think would be most relevant for people. So we'll go ahead and get started. Just a broad overview of how taxes are calculated. Basically, when you fill out the 1040, actually somebody had a question about the difference between the 1040 and the 1040 SR. 1040 SR is for senior citizens. The only difference, literally, is bigger font. So no big deal there if you don't fill out the correct form. So taxable income is added up. So to arrive at your gross income, that's all your wages, interest, dividends, capital gains, etc. And then if a lot of you probably heard the expression above the line deductions, those are things like student loan interest, IRA contributions, tuition and fees deduction, which actually goes away after 2020. So those are things, whether or not you itemize, you get those as a deduction. And then after you subtract those items, and again, that's not an inclusive list, that's just some of the common ones. So once you get to those items, then you have what's called your adjusted gross income. And I put a note on here too, for 20 and 21 only, there's a special if you don't itemize. You get $300 for a cash contribution. The way everything's worded, that's whether you're married or single for 2020. For 2021, that's a $300 for single or $600 if you're married. But again, that's if you don't itemize for deductions, just to kind of encourage some charitable giving during the pandemic. So right after you subtract all those items, you arrive at your what's called AGI. And that's an important number because there are lots of things that are tied to that. So we'll get into with some of the calculations, and you can move forward, Steve. And then you subtract either your itemized deductions or your standard deduction. Up until 2018, the standard deductions were lower. The Tax Cuts and Jobs Act in 2017 increased those amounts. So it used to be more of a no-brainer, basically, if you owned a house, because mortgage interest is a big deduction people get. And then for state taxes paid, that's income tax, that's real estate tax. And you can also select sales tax instead of income tax. There could be some opportunities to take advantage of that I'll explain when we get into Maryland. And there's a cap right now on state taxes paid that the maximum amount is $10,000. And then for charity, you can do cash contributions, non-cash contributions. Non-cash would be not only going to Goodwill and giving away clothing, but also donating stocks and bonds, things like, well, usually it would be stocks would be more relevant or more of a better tax strategy. And then I noticed here also there are greater amounts for if you're 65 or older, or if you're blind. And then once you subtract those items, then you get your taxable income. And a big thing with taxable income that a lot of people don't realize, they think that it's sort of all or nothing in terms of the tax bracket. So if you look, so here's the single tax brackets. I put these on here, and the next slide's married, filing, joint. There are some others, head of household, married, filing separate, but I figure those would be the two most common for this group. What a lot of people think is, so I'm, as an example, looking at this bracket, oh, I'm at taxable income 163.3. So if I end up with 164, then I'm paying an extra 8% on all my income. But it doesn't work that way. You go through each of these brackets and you pay the applicable percentage on each of those brackets. So even if someone made $10 million, they're paying 10% on their first 9,875, just like everyone else, and going through all those brackets. So don't be concerned too much if you have an opportunity to make a little bit more money that it's going to negatively impact you and then make you pay all this other tax on income you may have already earned. And then we'll skip ahead there are some other taxes to consider. There are preferred tax rates on capital gains and qualified dividends. Qualified dividends are basically any kind of dividend you'd get from mutual funds or any kind of, in IBM, Apple, any kind of publicly traded stock. There are some holding period rules and things, but for the most part, those are going to be taxed at a 15, either 0%, 15%, or 20%. Most people fall in that 15%. There's some calculations you do on the side to see where your other income falls. And then there's a net investment income tax that 3.8%. That's on investment income. Again, a complicated formula, but just to know it's out there. If your AGI, that adjusted gross income we talked about, if that were in excess of 200 if you're single, or 250 if you're married. And then self-employment taxes, we'll get into that a little bit more on when we talk about some things for small business owners, but that's a tax that takes a lot of people by surprise. And then there are tax credits. Some common ones are the child credit, the child care tax credit, earned income credit for people that have maybe lower income in a particular year, foreign tax credit. But a tax credit, the big difference between that and a deduction is a deduction just reduces the amount of taxable income, whereas a credit is actually a dollar for dollar reduction of your tax. So generally speaking, a tax credit is more favorable than a deduction. And then we'll get into Maryland. I see a lot of questions popping up. Are there some we should address now, you think, Jenna?
Yep, I was just about to hop in there for a second. So
Great.
I think this one is pretty, goes along with what you were just talking about, but how do you know when it's worth it to itemize versus taking general deductions?
Generally, it's adding it up and seeing where you stand so you add up all your deductions and then you'll compare that to the standard deduction. Generally speaking, unless you're very charitable, if you don't own a house or if your house is paid for, you're generally better off taking the standard deduction without even adding things up, because again, usually it's that mortgage interest deduction that gets a lot of people over the top. Otherwise, if you're highly charitable, then that might be something you look at. Or unfortunately, if you have a lot of medical, one thing I failed to mention on medical expense is that's only deductible to the extent it exceeds 7.5% of your adjusted gross income. So if you had $100,000 of adjusted gross income, the first $7,500 of any medical would not be deductible. So that would be something you look at. Now I had this on a later slide, but I can mention it now. Well, we're seeing a lot of times in Maryland, the standard deduction is much lower, and Maryland requires you to follow the feds. If you itemize on feds, you have to itemize on Maryland. Or if you take the standard, you have to take the standard on Maryland. So there are instances where you're right, you're a little bit less than the standard on the federal, but you might want to run it and look at Maryland, because even though your federal tax might be a little greater, you might end up, when you combine federal and Maryland, to know what your tax savings are in total. So it might be a situation where you might save, $600-700 because you're going to get so much more benefit in Maryland.
And Jeff, I think you've answered this already by the comment on deductions versus with charitable contributions, but I'm just going to bring it up since someone did ask the question. If you're only itemizing charitable contributions, is it worth it to itemize or not itemize? And do you have anything to share on that note?
That would be, you would look at your, yeah, it'd be looking at your standard deduction. So if you're single, you'd be saying, okay, it's 12,400. How much charity do I have? And then how much up to that $10,000 cap, how much state income tax or property tax have I paid? So if you gave $10,000 away, then you're single, then you're probably going to be better off taking the itemized deduction. If you gave $1,000 away, you're probably going to be better off taking the standard deduction.
Okay, thank you. I think we can keep going through the slides.
Okay. So then, since most of the people on the call are in Maryland, I figured I would go ahead and take the Maryland, or go through quickly also the Maryland calculation. And actually, in most states, this also is the basic mechanical structure. So the federal adjusted gross income is the starting point for Maryland, and then you make certain modifications. So some common additions are tax exempt interest from other states' bonds. For state employees, there's a state retirement pickup that is pretty common. That ends up being a subtraction later on when you collect your retirement. And then some common subtractions: U.S. bond interest, Social Security income, pension income. And I highlighted here, but not IRA income. There's a push every year, but it never seems to get through in the General Assembly to include IRA distributions as retirement income, to not pay a tax on them in Maryland, but so far that has not gone through. You can go ahead, Steve. And then here's what I mentioned, that you then deduct either your itemized or your standard deduction. And also, when you look at that for your itemized deductions in Maryland, you add back any state income tax you deducted on your federal return. You don't add back your property or sales taxes. And I highlight sales taxes there because, especially if you have kind of high property taxes, you can deduct either sales tax or income tax on your federal return. And based on your income level, and then based on I believe it's based on your zip code, there's sort of a standard amount you're allowed to take for sales tax. So you don't need to specifically track it, but you can also add to it major purchases. So if you bought a car or something. So sometimes, again, you're better off looking at that sales tax formula plus your property tax, because you don't have to add that back in Maryland, whereas you would have to add back any state income tax you deducted. And I should point out too, the deduction for the income tax is the amount you paid. So if you had withholding and it was more than your tax actually was, you still deduct it, but then your refund the following year is taxable on Maryland. I'm sorry, on federal, and then you get a reduction of that on your federal return or on your Maryland return. And then I talked about this with the tax saving opportunity in terms of the looking at standard, even if, or looking at itemized, even if you took this, may otherwise qualify. And then, yeah, again, now one difference in Maryland, you still get exemption allowances. For those of you really new to the game, it used to be until 2018, you got an exemption. So for your dependents, for yourself, for your spouse, it was another few $1,000s per exemption that you also subtracted. Maryland does still have those in place. They do phase out, meaning they get reduced once you have the income as shown here, 150 single or 200 married. And then again, you have your Maryland taxable income. Maryland's a little different, that even though you're calculating it on a Maryland return and remitting it all, there's a Maryland tax, and there are tax brackets there. that are also graduated, like we talked about with the federal, but then there are also county rates. So depending on what your county of residence is at the end of the year, you look at that rate, and they vary. I think Worcester County is the lowest, and then I forget which county is the highest, but the highest is around 3.75, and I think the lowest is about 1.75. And again, there are some credits in Maryland similar, like Fed, they're better. They reduce your tax. A common thing there is if you have if you have income in another state and you pay tax in that other state, you get credit on your Maryland return up to the amount you would pay in Maryland. So if you paid 4% tax on income in Virginia, then you're not going to pay tax on the same amount in Maryland, but you would in California. If you pay 10%, you'd only get credit up to the amount that you would have paid in Maryland. Or similar in Virginia, you'll pay a little bit more.
Hey, Jeff,
Yeah.
just a quick question. Because I know you mentioned this on the last slide. When is it better to file married versus married and jointly? I guess married individually and married jointly.
It's funny you said I actually had that I was going to cover later, but I'll cover it now. It's almost never better. We get asked that several times a year, especially in situations where people have significant differences in income. But the way that the tax code is written, the way the tax brackets are, it's not like saying single plus single. You get up into the higher rates quicker. Also, if one spouse itemizes, the other has to. So you can't just let one person take all the mortgage interest and everything like that, and then have another person take the standard deduction. They would have to do the same thing. And also there's a few different credits and some other deductions that neither of you are able to get. It's usually more of a logistical reason. People file separately. They're going through a divorce, so they're still legally married, but one spouse doesn't want to be on the return with the other for liability purposes. Sometimes if somebody's in an installment agreement, a payment plan with the IRS, they'll file separate. So if there's a refund by one spouse who's not in that, then they won't take it. But just from a tax savings perspective, in 22 years of doing this, I think I've seen one instance where it was better off, and that was just by a few $100s.
Thank you.
Yep. Then we can move ahead, Steve. And then here was a big one. Everyone saying, hey, I'm working from home now. I get the home office deduction, right? Unfortunately, no. It's when the tax law changed in 2018, well, it changed in 2017, effective 2018. There used to be what were called 2% miscellaneous itemized deductions. Unreimbursed employee business expenses, which home office expense for an employee would fall under, they went away. So unfortunately, any expenses you're incurring at home that you're not being reimbursed for are just no tax benefit. Now, if it makes you feel better that there were still a lot of criteria and hoops to jump through to be able to deduct it before, but that's one of the ones that people were hoping for that they can't get. Now, if you're self-employed and you're filing as sole proprietor, then yeah, you absolutely still get it. Again, it's subject to some criteria. It's got to be an exclusive use. You can't be you can't be working in a different room every day and write off your whole house or anything like that. Another big thing I put here, extensions. People think they're a red flag. Actually, two misconceptions there. One, people think they're a red flag that you'll get audited. Not at all. Lots of people file extensions, whether they're waiting for additional information or they're a CPA who are busy working on other people's returns. And also people think and we might see this unfortunately this year with people who might be struggling with cash flow, that an extension is simply an extension of time to file, not an extension to pay. So if you were collecting unemployment, you didn't have withholding, and you're looking, oh my gosh, I'm going to owe a few $1,000s. I'm not going to have it. I'll just file an extension. Unfortunately, that extension will not extend your time to file. I mean, to pay, sorry. All right, you can go on, Steve. Another big one I hear is, you know what, I'm entitled to that stimulus payment, but I didn't get it, or I didn't get the full amount because I had a baby, or et cetera, et cetera. The stimulus payments are really just an advance payment of a 2020 tax credit that was put into place. So as long as you on your return are entitled to it, if you didn't get the full amount, you will get it as a tax credit on your return. So you'll still get the payment for having the baby, or if your income was higher in 2019 and that's what it was based on, or in 2018. So you will still get it. And even better, if you got it and you really shouldn't have, in terms of the calculation, then you get to keep it. Now, there's some different rules if a decedent got it or something like that, but if you work it out and you weren't going to get the credit, you get to keep it. Another thing that this, again, going back a few years, when the new tax act came out in 2017, there was a big thing about home equity loans not being deducted, the interest not being able to be deducted, which is true. The change was, it used to be that you could go out, you could get a home equity loan, you could go buy a car, and you could write off that interest up to certain limitations. That has changed. What has not changed is you get a home equity loan and you put on an addition, or you build a deck, or anything that's home improvement. That's still considered, in the term of art here, is home acquisition indebtedness. That's still deductible. So if you have a home equity loan, you used it for that purpose, don't just ignore that 1098 when you get it. You can still write off that interest. All right, we can move ahead. Another one I get all the time, hey, I've got an LLC. Can I go buy my groceries in it? Because that's a business, right? And then it's, no, sorry, or people think they can kind of do anything. A business expense still has to be for a business. You can't, there's a doctrine out there called substance over form. So the substance of a transaction is looked at more than the form of one. So if you're thinking of starting an LLC just to get a bunch of tax write-offs that wouldn't ordinarily be written off, they're still not. And then there's more chance that the IRS could accuse you of fraud. So you don't want to go down there. Married filing separate, I already hit on that one, so we can skip ahead. Okay, before we move on, were there any questions there, Jenna?
Yes, this one goes back to the stimulus payments, and I don't understand this myself, so I'm glad this person brought it up. But if you've got stimulus payments, is that considered income and therefore part of what you need to, consider for your taxes?
That is not considered income, nope.
So what's the, so they won't actually, it doesn't come, you don't get a form for that, so that's nothing you need to worry about filing or putting anywhere on your tax returns.
Correct. The only thing you'll need to worry about is if you got it, you'll just need to indicate that you got it, so it will reduce the credit. So you can't get the credit twice, but it's nothing that's going to get added to your income.
Okay, and I'm guessing that's something that if you use TurboTax, there would probably be like a checkbox or something saying, did you receive?
Yes, okay. Yep.
Perfect. Thank you.
Yep. Any other questions, or should I move on?
I think we can move on. I just do want to note that there are some questions that have come through that I will be waiting until the end to bring up, but I think we're good to move forward. Yep.
Okay. And I'm kind of going in order here for people that when we polled everyone with that survey, of these were kind of going in order of what were the most popular things people wanted to learn about. And retirement plan distributions, that's always a big one. I you contribute over time to an IRA, and you're tax deferred growth, and you're in a lot of cases you're writing off you're deducting your contributions to it, whether it's an IRA or 401k. In time, the Congress is saying, well, we want to start getting start taking out distributions. That did go up to 72 years old in 2020.
Jeff,
Rumbling.
Jeff,
Go
I'm
ahead.
really sorry. You seem to be to have some service issues there, so we did miss a good portion of what you've been talking
Oh,
about. I don't know if you can start again. It has been happening
sure.
just the past maybe minute or so.
Okay,
Jeff,
sure.
Jeff, do me one favor. If you could turn off
Yeah,
your camera temporarily, that'll help your
yeah.
bandwidth. That'll keep it for audio, and we'll make sure we can hear you.
Okay,
Thanks,
I've
sir.
got it off. Uh, can you hear me now better? Can you hear me better now?
Yes, sir.
Okay, great. So yeah, I'll just start at the beginning. The minimum distributions, this does not apply to Roth IRAs, but everything else. And I was just sort of setting the context that the reason behind this is for so long you will have deducted your contributions to a retirement plan potentially, and it's growing all these years tax deferred. So Congress says, okay, eventually we need to start collecting the tax on that money. So it was 70 and a half as the age, and then it moved to 72 in 2020 or later. There are rumblings of that maybe even going up to 75, but that's not concrete yet. So the idea being that, okay, you have these balances now, you have to start taking money out of them, whether you need it or not, so we can start paying tax on it. So it's usually, it's based on an actuarial table, and you can get that from the IRS. Plus, most custodians calculate it for you. And then if you have 401ks or 403bs, you have to take the amount from each account. If you have 3 or 4 IRAs and you need to take out $10,000 in total, you can just take it from one IRA. It's a big thing not to miss this. It's a 50% penalty for if you don't take it timely. And the IRS is very forgiving on that, I'll admit, but it's something you'd rather not even have to face. And then I put in here, there is a special rule for 2020 that you didn't have that in March 2020, they passed a bill saying that you don't have to take the RMD for 2020. If you had already taken it, you had until August 31st to put it back. If you took it and you didn't put it back, well, now it will be in your taxable income. And you can go ahead and go forward, Steve. And then there's also an option if you don't need the money, and this is especially good if you take the standard deduction. If you're charitably inclined, you can actually, so if you want to give to Towson University Foundation, for instance, you can say, you know what, I need to take out $10,000 this year. I do not need the $10,000. You can have what's called a qualified charitable contribution. So you can have it go from the IRA directly to the donee, and that is out of your AGI. And again, it's perfect in the situation, especially if you aren't itemizing your deduction. So it basically gives you that deduction. So that's a really big thing. And that applies only if you're in this RMD situation. If you're 65, you can't do it. But once you're at that age, you can do it. And then we can skip ahead. And I think that I saw a question, I think, about the inherited IRAs.
Yes, it's a true or false question. They're asking for inherited IRAs. Must you take the full required minimum distribution from each account?
I would have to check. I can follow up later. I don't know if you would have. I don't know that for sure. I'll have to check on that, and I can get it back to you, Jenna, I guess. And are you able to follow up?
Sure, I can do that. No problem. Thanks, Jeff. We can continue on.
Yep, okay. And then, okay, so we are on then the flip side is there are early withdrawal penalties. That's a 10%. And that applies even if you don't have taxable income for the year. I've seen clients in that unfortunate situation where they've taken out a lot from their IRA, and then they ended up, because of other business losses, they don't have income tax, but that 10% of the amount they took out still applies. Now there are exceptions to that. So I listed a few of them on the slides where obviously if it is an inherited account, then that's an exception. You can be under 59.5 there. Disability, extraordinary medical expenses, and then qualified higher education, up to 10,000 for a first-time home purchase. And I should point out on all of these exceptions, that's an exception just to the penalty, to the 10%. These would still all be taxable events, so you would still pay tax on it. So if you took out $10,000 for the first-time home purchase, you're not going to pay a $1,000 penalty, but you are going to pay tax. So it might still cost you $2,000 or $3,000 in taxes or more. Okay, you can move ahead, and there's one big thing here for COVID-19. So this obviously was also a 2020 update, that there is the penalties waived for distributions up to 100,000. If you or your spouse test positive for COVID, or you had other adverse financial consequence, again, still subject to tax, but you have actually a 3-year period to pay it back. Okay. Any other questions here on the retirement, Jenna?
There is a question that just came through. I'm not sure if it actually pertains to this topic, but I'll read it anyway. It's, if you cashed in a flexible premium variable life insurance account, does it count as income?
I'd have to check on that with more details. It sounds like it probably does, but there might be a basis. So if you have a cost in that and you cash it out, your income would be that amount less the cost, but I'd have to see further details of that transaction to really be able to fully answer that. It smells like it's taxable minus your cost.
Okay. All right, I think we can continue on.
Okay. So then another topic here was education savings and 529 plans. That the 529 plan, it's section 529 of the Internal Revenue Code. They're run by the different states. There is no federal deduction for the contributions, but there's tax-free growth, and so you can use it for college tuition and fees. So the idea being you might only be putting in over the child, 1 to 18, maybe 20 or 30,000, and it grows to 50,000. None of that growth is taxable. So that's the big federal benefit on those. And then you can go ahead and flip over, Steve, for for Maryland. There's a deduction of $2,500 per beneficiary per contributor. So essentially, a husband and wife could each contribute and deduct up to $5,000 per child. And I meant to note on the last one, a change a couple of years ago was you can also use up to $10,000 per person for tuition for K through 12 education. I don't usually recommend that unless you have enough in there anyway, because then the only real benefit of that is the Maryland deduction. You're not going to get that growth that I think is the bigger benefit of this. And then I also point out here that when you take amounts out of a 529 plan, you can't use those same amounts to to take any kind of education credits like lifetime learning or American Opportunity Credit, tuition fees deduction. To the extent you have costs in excess of what you take out, you can. Then the Coverdell, yes, that was around before the 529 plan. It's not really used that much, but I put it here just because it's still available. That's a $2,000 maximum contribution. What people like about it is that there's a lot more investment flexibility. A lot of 529 plans, you're kind of locked into whatever they're invested in, but with the Coverdell, you can invest in whatever you want. Okay, I know I kind of went through that kind of quick. Were there any questions there, Jenna?
No, nothing's come through for childcare yet.
Okay, and then, so small business owner taxes. This got, seemed like a lot of people, whether they've got a major business as their main income, or a lot of people now have a side business that they're doing. And I will point out, you could be a small business owner, but own it as an S corporation, or maybe two of you have a partnership. My discussion here, while some things may apply on either side, this is what's just in the context of someone filing what's called a Schedule C, which is just a schedule within your own tax return. So there might be a few things here that wouldn't necessarily apply to any kind of corporate tax return. Most important thing is to keep separate accounting. Keep your personal out of your business, have separate bank accounts, credit cards. Even if you don't have a separate ID, at least just have a bank account or a credit card that you only use for that business. It gets really murky and cloudy when you start paying personal expenses out of the business. If you need to do that, just transfer it over to an account that you use just for your personal things first. Personal assets can be used, but you should track your use of them. Like we mentioned, the home office you get, automobile expense, you can deduct that. Again, only to the extent you're using it for your business. And commuting doesn't count. So if you actually have an office that you're commuting to, you don't get to deduct that. But if you're driving around visiting clients or going and meeting with people, that's different. You do get to deduct that. You can go ahead, Steve. And then again, this is the big gotcha. A lot of times when people, especially when people are just starting off with their own business, the 15.3% self-employment tax, that's both sides of your FICA. And actually I had a typo here. I meant to add Medicare after the 1.45. When you're an employee, you're paying 7.65% of your wages up to a certain amount. And then your employer is also paying that same amount. Well, when you're self-employed, guess what? You're the employer and the employee, and you pay that regardless of whatever other deductions you have outside of the business. So if your net income from the business was $100,000, then you're going to pay $15,000. You might have other deductions that might bring your taxable income down, but you're still going to have this tax. You do at least get to deduct half of it above the line we talked about earlier in regards to coming up with adjusted gross income. But that's really a big kind of gotcha for a lot of people. So certainly if you're just starting out in this, make sure that's on your radar, and obviously you'll pay income tax on it too. And then estimated tax. If you're an employee, you have withholding. If you're self-employed, you don't have withholding. And estimated tax also applies if you're in any situation where you don't have withholding, but maybe you have just retirement income or investment income, but see it a lot again with small business owners who may not be prepared for that. In order just to avoid penalty, you've got to pay in either 90% of your current year that you estimate, or 100% of your prior year, or 110% of the prior year was 150. So usually if your income is going to be kind of stable, it's easier just to do it based on the prior year. But if your income fluctuates a lot, you need to look at it quarterly and see where you stand each quarter and get those payments in.
Hey, Jeff. A question for small business owner taxes did come through. The question is, if you have been operating a small business as a hobby and have been filing the Schedule C for 10 years, but now your hobby has tapered off to almost nothing, at what point can you stop filing the Schedule C?
That's a good question. It's really no kind of, technically as a hobby. So actually, I guess that they actually have income from the hobby. As long as I would keep filing it, as long as it's profitable. Once it's no longer and once it's no longer profitable, then I would not have it on a Schedule C, because then you get into what's called the hobby loss rules. If you have income from a hobby, but you have the deductions, you can take some deductions against it, but once it's no longer profitable, I would stop having it on the Schedule C.
Perfect, thank you. I think that answers that question.
Okay, good. And then I added here, I know we're running up against time. There's some retirement savings you can do that you can actually, in a lot of cases, depending on your income from a Schedule C, you can get more into retirement than you can as an employee. So there's some potential tax savings there. And then health insurance, if you have health insurance through your self-employed business and you don't have any other access to a subsidized plan, you can deduct all those premiums. Again, that's an above the line deduction. And then we can move on. And then another thing people often say, hey, I still have all my money in the business account, so I don't have to pay on that. No. For a Schedule C, it's really just considered disregarded. The income you make, whether you paid it to yourself or not, you still have to pay tax on it. And there's also something out there, and we could do a 3-day seminar on this, but called the qualified business income deduction. Just know it's out there. You might be able to get phantom deduction. I say phantom because there's no actual cash that comes out, but just a reduction of 20% of your income from that small business. And then another thing, I see people sometimes want to pay themselves a salary. You can't pay yourself a salary, but you can, as long as they're actually working for the company, you can pay a spouse or dependents. And then there could be some additional tax savings there to move some money around or to do some additional retirement investing. So you can go ahead and move on, Steve. And then just some other planning considerations. One thing, if you are looking to make contributions, maybe look at contributing stock rather than cash. The idea being there, if I have stock that's worth $10,000 and my cost is $2,000, I can donate that right off the full $10,000, but I never had to sell it, versus just writing a check for the same amount. And then you don't see this much, but just so you know, it's out there. Usually there's it was 50, now it's 60% of adjusted gross income that can be contributed, but for 20 and 21, you can actually give away up to 100% of your adjusted gross income and write that off. Might come into play, especially if you're someone who didn't have to take the required minimum distribution and there's some things you want to do. Maybe that's something you could take advantage of. I put here bunching of deductions when you're close to the standard. That would be more things you may have control over the timing of. So if you're looking at charitable contributions, that's a big one again, that because you can control when you do that, you can't really control when you pay your real estate taxes if you want to pay them on time. And so if you're close, some years maybe load up on your charity and do your year end in January and then again in December. That might help out. I mentioned the sales tax instead of income tax, looking at that. Also, health savings account. If you have a high deductible high deductible health plan, use the health savings accounts, because you can either do it through payroll and it comes out pre-tax, or you can contribute. And that effectively is a way to deduct your current medical expenses, because you can deduct the contributions to those accounts and then use the contribution to then pay your medical expense. You can move on, Steve. And then when to consider hiring a professional. It's kind of half joking, half not. Sorry, what you made just not feel like doing it. That goes with a lot of things, but also significant change in life, a death of a spouse, a divorce. If you move to a new state, I would, especially if it's not as clean as you just moved at the end of the year, beginning of the year, I definitely recommend that. I see a lot of people get into trouble trying to do their own return when they're between two states. If you have an inheritance, including inherited IRA, you start a business, or if there's really just any kind of complication that you don't understand. And then I thank you for your time. Sorry I had to speed through a few things, but I wanted to leave a few minutes here for questions that I'm sure we've been accumulating.
Thank you, Jeff. I do have a few questions that came through. So I'm going to try to get to as many as possible. I'm going to start with two that are a little bit similar, and they have to do with the stimulus checks. So the first is, if we get the third stimulus soon, they haven't gotten it yet, should we wait to file until they get the stimulus, or does it really matter?
It probably doesn't matter, but I would probably wait, just because I would hate to indicate on my return that I got it, and then for some reason I never actually got it, and then I'd have to go back and amend to try to get it as a credit. So I would recommend waiting.
Okay, and that links in then the second question, which is similar. And that question was, if the payment was mailed according to the IRS website, but you have not received it, can you still claim it? It sounds like you're suggesting if you see on the website that it's been mailed, that you should really just wait until that payment has been received instead of just claiming it, correct?
I would, yeah. Now, if it gets up and it's April 10th and you just want to file and get it done with, I think that having the indication that it should be on its way might be okay. But the risk is on you. So the IRS wouldn't necessarily argue with you that you said you got it when you didn't, but it'd be more that if you ended up never getting it, the risk is that it could be harder to get at that point.
Okay, thank you. This actually ties in right into you were talking about if you were moving states. This individual said that they moved from Pennsylvania to Maryland in 2019, and their 2019 Maryland refund was considerably high. But now for 2020, the Maryland refund is looking significantly less. Is this something that's common? Is it hard to say, or is this one of those issues that maybe they should have or should go with an accountant to confer?
Probably go with an accountant. And I'm wondering, yeah, because it sounds like there might be more to it. If they moved in 2019, it sounds like they might have some other what's called nexus in Maryland, where maybe some kind of business activity or something. I should point out there's reciprocity with wages. So if you live in Maryland or Pennsylvania and work in that other state through the reciprocity agreement will not tax your income. So you live in Pennsylvania and you'd come down and you work in Maryland, you're only paying tax on your Maryland wages. So you're only paying tax to Pennsylvania on those Maryland wages. So that might be something they might want to look a little further at.
Okay. This individual is asking that they are a 1099 employee for the first time. Are there forms that they should be completing since they didn't pay taxes on this income?
That would be where they'd likely do that Schedule C I was talking about as a small business owner, assuming they have some sort of expenses against that. If they don't have any expenses against it, they could just report it as other income, but they are going to have that self-employment tax I was talking about. If it's 2021 that they've started, they should look at making estimated tax payments quarterly, like we were talking about in the small business owner section, that first payment will be due April 15th. And then it'll be June, September, and then January of 2022 for fourth quarter.
Okay, thank you.
Mhm.
Here's another question. Can you claim head of household if you are single and claim the children living in your home that are not related to you if no one else claims them on a tax return?
If they're not related to you, I don't think you can, but I'm not 100% certain. Usually I've seen it be a little cleaner where single but have, related dependent children living at home, and then they get head of household. So I'm not positive in that fact pattern if they get head of household or not.
Okay, so that might be another one we want to reach out to an accountant,
Yeah.
personal accountant for some help. I think I know the answer to this question, but I'll let you answer it since you're the professional.
Okay.
Can fees be paid that are paid to BGE Home for maintenance of appliances, a heater, or other items be included in home office expenses?
They can, yeah. Now, the way the home office expense works is you take your percentage that you're using for your business as a percentage of your whole house. So if you had a 200 square foot office and you've got a 2,000 square foot house, it's 10% of all those expenses that you incur for your house. Now, if you had direct expenses, like you had a separate phone line or something, you'd get all of that. But yeah, landscaping, anything you get.
Okay, I'm going to read two questions. You might have touched on it already, but I do want to make sure this person gets these answers. Do you have to pay taxes when receiving a pension?
You do, yep.
And then the other question is, do you have to pay taxes on Social Security benefits?
That depends. Depending on your income level, it goes from a 0% up to an 85%. So probably, unless that's their only source of income, they will probably need to pay tax on that. Now, in both those instances, there are tax breaks in Maryland for pension, Social Security, but on federal, generally Social Security is taxable unless that's your only income.
Okay, and I'm going to end with this question. I think this might be another one where someone might have to reach out to a professional advisor, but I will ask it. We have been taking standard deductions since paying off our mortgage. Recently, we inherited property, including 2 households worth of furniture that most was donated. The receipts don't quote any totals. How much of our donations can we itemize without getting audited?
Well, there's no real cut and dry about being audited or not. There are, hopefully you have an inventory, and for people listening, when you make a major contribution, there's things out there. There's, I think, Deduct Me or some other programs where you can kind of inventory and calculate values. If you kind of recall what you looked at, you can look at different valuations that are out there for, I know that Goodwill and Salvation Army have them, and you can kind of put together an inventory and a listing and value it that way. Now, in terms of the value and what's going to raise significant red flags, if you have anything that you're suggesting is worth more than $5,000, then that needs to have had a qualified appraisal and also a separate form signed by the appraiser as well as the donee. But probably a house full of furniture, there may not have been one thing in particular that was over 5,000. But yeah, hopefully they can at least recall a lot of what they donated and come up with a decent estimate based on those valuation sheets that are out there.
Okay, well, Jeff, I want to thank you again for joining us and leading us through this process. To me, it's very confusing, so I appreciate you taking the time to spell out some of these items and answer some questions. So it's a little less daunting of a process. I hope everyone enjoyed this session and are leaving with some new tax knowledge. If you were unable to get your questions answered today, or you'd like more individual assistance, please reach out to Jeff. His information is now in your window. I'd like to take a moment to remind our attendees that Towson is still raising money for the TU Student Emergency and Food Insecurity Fund. Every gift counts, no matter the size. These gifts go directly to support our students who are experiencing challenges in their lives, especially right now with most of them going through remote learning. The funds can help our students with internet access, laptops, supplies, webcams, and other technology needs. You can make a gift today using the link in your chat box. I'm putting there right now for you to see it. You can click on that link and go right and make a donation. We do hope you can join us for some of our other upcoming events. This was our first event of 2021, and we have a pretty exciting spring schedule. Next week on February 3rd, our Towson Business and Leadership Alumni Alliance is hosting a seminar on enhancing your LinkedIn profile. And then a fan favorite, the Alumni Cooking Class, returns on February 11th with a special Valentine's Day themed recipe. And on the 16th of February, we're hosting a panel of alumni artists, including a theater director, Broadway performer, and musician, who will all be sharing their experiences post-TU and creative ways they've used their talents and expertise during the pandemic. You can register and learn more about all of these events at alumni.towson.edu/events. Please make sure you follow the TU Alumni Association on our social media channels and on Tiger Connect, which is our alumni community. It's the page you would have gone to register for this event today. The details are now on your window. Thank you so much for joining us, and we look forward to seeing you next time.